Hi, I am Melissa McGlinchey with ACM Home Loans, and I'm here with one of my loan officers, Michele Thomas, and we wanted to come to you today to discuss self-employed buyers. On our end, it's self-employed borrowers because we're on the lending side, right? So we're looking at the lending aspect of it. So what I'd like to start off with is what defines somebody as being self-employed. Many people will say to me, well, I own the company, yes, but I W-2 myself. All the income that I earn is by way of W-2. And in saying that, they think that they are not considered a self-employed buyer because they W-2 themselves. In reality, self-employed means that you own more than 25% of the company, okay? There could be multiple owners with the company, but if you own more than 25% of the company, you are self-employed. Whether you think you are or not, you are self-employed. Sole proprietors, if they use a DBA, they operate under their personal name and they show that on the tax returns like that, they are, of course, also considered self-employed, but many times we don't look at the borrower who possibly owns the company and is W-2'd as self-employed when they are. So it's one of the questions that we always ask is what percentage of ownership do you have of the company? So let's start off with talking about conventional guidelines, okay? I'm gonna bring Michele in. I brought Michele in because I want to talk about the intricacies of non-conventional guidelines with Michele. She's our pro in the office with our non-prime. But I want to start off by talking about the conventional guidelines that a lot of people know about, hear about, and might not necessarily understand the whys or the how-tos behind something. So normally, in a normal world, you would look at if someone's self-employed, we automatically ask them for 2 years tax returns, right? Correct. It's just kind of the said thing. Okay, you're self-employed, I need your last 2 years of tax returns. Sometimes people will come back to me and say, well, such and such company said I only need my most recent tax return. Yes, there are scenarios where that's the case, but you never want to assume that up front, okay? It's once you dive in a little bit deeper to that borrower to see, do we need 2 years or do we need 1 year of tax returns? We won't know that until we get a little bit deeper into their file. So your normal conventional guidelines, which are your Fannie Freddie, they require the borrower to be self-employed for 5 years or more. And if they are, then we only need that 1 year of tax return, okay? If they've been self-employed for less than 5 years, we're gonna need those 2 years of tax returns. And it's just because they haven't been self-employed long enough to substantiate not using the 2 years of returns to see a history. So we want to see that history of how they've been sustaining themselves with their company of being self-employed. And that's the reason for the 2 years of tax returns. Many times, and this is where we're gonna start talking about some non-prime, many times because you're allowed to, per the IRS, write off a lot of expenses for your company, right? And what happens with that case is you don't show enough net income to qualify for a mortgage. And people will come back to me and say, but my CPA told me I could write off all of this. And in reality, they're right, they can. But just because you can write it all off doesn't mean that you can qualify for a mortgage because you wrote it all off. So we're looking at your net income. There are some minor things we can add back in, but for the most part, we're looking at your net income. Don't want to get into all those little guidelines like that for what we can add back in at this point in time. So what happens is if we cannot qualify them using their tax returns, there's still another option. And it's called non-prime. We like to call in our office alternative lending, non-prime lending, but you're basically going another route. And this is what I want Michele to talk about is another route. Now this is for the self-employed borrower. The route we're gonna talk about is really for primary residence today. And that is because primary residences are protected. So since the fall of the market, you've got more protection on a primary residence than you do an investment home. And the reason for that is because the government doesn't want people to lose the roof over their head, right? That happened way too often with way too many people. So they put systems in place to prevent that from happening again. So when you're trying to purchase a primary residence and you're self-employed, you're a little bit more restricted for the programs that are available, okay? But one of the most prevalent programs is called the bank statement program. So I'd like Michele to kind of go over what is a bank statement program when we talk to a self-employed borrower about, okay, well, you don't necessarily qualify conventional, but you might qualify by using the bank statement program. What does that mean?
Okay, so a bank statement program, we have two different kinds. We have a 12-month bank statement program and a 24-month. And we would get 12 months or 24 months of bank statements from the individual. It can be personal or business bank statements. And we look at all of the deposits and average those out over the 24 months or 12 months to get a monthly income based on those deposits.
So what's the difference between using personal bank statements or business bank statements? Why would one person use one as opposed to the other?
Okay, so if you are depositing all of your money into a personal checking account, you would, if you are the only person on that account and you do all of your business through that account, that would be the better option because we are able to use 100% of the deposits for figuring your monthly income. Whereas in a business bank statement program, you would have 50% of those deposits averaged out for your monthly income.
So that's a big difference.
It is a big
50%
difference.
compared to 100%
Right.
of the deposits. So let's go back to that personal bank statement scenario again. If somebody's depositing all their money, okay, into their personal checking account, but their spouse is also on the personal checking account, does that make a difference?
That makes a big difference. So basically we would treat that as a business bank account then. So instead of using 100%, we would only be able to use 50% because you have another person on that account.
What if we put that other person on the loan?
If we put the other person on the loan, yes, then we can count 100%.
All right. So you can see that there's some little quirks that come about with this. There were also some other things that we wanted to discuss about with little quirks. And let's talk about those little square devices that are very, very prevalent these days, right?
Right.
And what if someone's using that square device and they're using a personal bank account?
Okay, so normally if you are using deposits into a personal account, it's going to be bigger deposits. So if you are doing business and you have the customer pay on that little square, then it's going to be treated more as a business account instead of a personal account, and then they will only allow you to use 50% of those deposits instead of 100%.
Okay.
So it's kind of in how you use that personal account and how you deposit your money into the account will depend on whether we can use 100% or 50% of the deposits.
Okay. What about unusual type deposits? How are those looked at?
Okay, so we're going to be looking at all of the deposits for that whole year or 2 years. If you have anything that, say you normally are depositing $500 or $600 at a time and suddenly you have $3,000 you're depositing, they're going to want to know what that deposit is from. Is it actually from business or is it something different that we cannot
Did you get a
count?
loan? Did you get money from a family member?
Right.
You know, what was
anything
unusual?
out of the ordinary is going to be a red flag that, okay, what is this deposit from?
Okay. So basically what we're trying to say is, besides going your normal bank statement program to purchase a primary residence for a self-employed individual, that person, because they write off so many expenses that their net income doesn't show to be very high, they could actually use the deposits that go into their bank account, and we can use that as their income. Now, how much we get them qualified for is going to depend once we start digging into, is it personal, is it business, and we start looking at all of their deposits. So clearly there's a lot more to it than just this little conversation, which is why it's so important to make sure that you choose a lender that is very well versed on this type of program and all the other different types of programs that are available. You look at guideline changes. I mean, we just had multiple guideline changes this month with Fannie Mae with all different types of programs. Last year we had, over 110 guideline changes between FHA and Fannie. So guidelines change consistently. There's no set day or time each year that guidelines are going to change. It's our job, being your lender, to make sure that we stay on top of those guideline changes because they do happen consistently. And the reason I wanted Michele in here to talk about the bank statement program is because I utilize her a lot for that. She's done quite a few of the bank statement programs, and many times when I bring in a borrower that I see needs to go bank statement program, most of the time I'll pass it off onto you, right?
Yes,
yeah.
most of the time.
Yeah, and it's because I trust her, and I know that she's very well versed with this program. I know that she's going to do a great job just with any other type of loan. Of course, we all do a great job in here, but with the bank statement program, I'm very comfortable with knowing how she'll handle the file. If you have any questions for us regarding self-employed borrowers, we are going to do more of these live videos throughout the weeks to come about different hot topics and different questions, concerns, trying to cover and help keep people informed about different options that are available out there. But feel free to drop a question below in this live video. Afterwards, we will definitely make sure that one of our loan officers gets back to you right away. And if you're a realtor and come into issues with self-employed borrowers, I do get a lot of fallout. Funny, it's probably a lot more from builders than any other place, because for whatever reason, they just don't do a great job of trying to look at different routes to qualify self-employed borrowers and analyzing their financials. So if you're a realtor and you have a self-employed borrower and the file is going astray right now, or you have the tendency to have self-employed borrowers and need some assistance, please feel free to reach out to us. We would love to assist you. Have a great day.
Thank you.